Evaluating business funding options requires deep diligence, especially when dealing with prominent online financial platforms. Newtek operates as a major player in the commercial lending space, functioning through Newtek One and Newtek Bank. Legitimacy is established through its corporate structure. Newtek One is a publicly traded financial holding company listed on the Nasdaq under the ticker symbol NEWT. Furthermore, Newtek Bank is an FDIC-insured institution, meaning consumer deposits and banking operations meet federal regulatory standards. Rather than operating as an unregulated online broker or predatory lender, Newtek functions as a legitimate financial institution recognized nationwide, frequently ranking as a top-volume participant in government-backed lending programs. Safety and operational reliability involve looking closer at how they handle transactions and client files. As a preferred lender authorized by the Small Business Administration, they process thousands of SBA 7(a) and 504 loans alongside conventional term loans, lines of credit, and electronic payment processing. Their core financing products span amounts from $5,000 up to $15 million, designed primarily to support established commercial enterprises rather than raw startups. Because they adhere to strict federal banking guidelines, the security of user data, financial records, and institutional transactions complies with standard banking encryption and privacy laws. The application process carries specific procedural realities that every applicant encounters. Securing capital through government-backed or conventional commercial channels demands extensive documentation. Borrowers typically must submit multiple years of business and personal tax returns, detailed profit and loss statements, balance sheets, and proof of collateral for larger funding requests. Underwriting timelines for SBA files generally run across several weeks rather than days due to the comprehensive compliance checks required. Client experiences highlight distinct operational divides. Positive feedback frequently points to knowledgeable loan specialists who guide applicants systematically through complex paperwork. Borrowers also value the extended repayment terms, often stretching from 10 to 25 years, which keep monthly overhead manageable without sudden balloon payments. Conversely, criticism often centers on communication bottlenecks during peak seasons. Some applicants note that response times can lag while files sit in underwriting, and specific interest rate tiers or fee structures are not always fully transparent upfront on public web portals, requiring direct consultation with a representative. Determining if this lender fits a specific business plan depends entirely on corporate maturity and financial positioning. Companies with strong revenue history, clean credit profiles, and a need for long-term capital will find the institutional framework reliable and secure. Early-stage ventures or companies needing immediate, same-day cash injections may find the rigorous documentation and extended processing windows misaligned with their immediate operational timeline.